Friday, January 12th. We are 2 whole weeks almost into New Year's predictions, accuracy test, and I got one. I said importantly 2 weeks ago that the fate of U.S. interest rates would depend a lot on foreign central banks. Hey! Japan, for renewed suicidal reasons, is beginning to have the Bank of Japan back away from buying bonds, and so its rates rose a little. And the European Central Bank, under great pressure from Germany, has done the same thing. And so the rise in U.S. mortgage rates, I think, has a lot more to do with those central banks pulling away than it does with anything intrinsic to the United States. Our inflation rate is still low. Their inflation rate is low. So just for perspective, we went through the whole of 2017 with mortgage rates 1/8% on either side of 4. That's not what you'd call volatility. But given the species and the way that it is, if you go through a year that's that peaceful, it's a shock when we move 1/8% up out of that range, and we really haven't done that yet. We may, but not yet. The credit markets have built in a Fed tightening move in March, another 0.25%, and they've begun to build one in for next summer, but the economic underpinnings of the Fed and the marketplace really have not changed. The retiring New York Fed chief, Bill Dudley, who's completely apolitical, he's just a banker, regulator, and a good one. In his term, the last 10 years at the New York Fed, the primary job of the New York Fed is to keep Wall Street from stealing from the rest of us, and we haven't heard a peep from those boys in 10 years. Dudley and his people figured out anything that they were up to that might lead to trouble, and so there hasn't been any trouble, in marked contrast to his predecessor. Dudley yesterday gave a speech in which he indicated alarm at the tax bill and said that it would magnify the two greatest risks ahead of us as a country, which are the potential for an overheating economy, which the Fed would have to intercept, in a recession, and secondly, that it weakened our fiscal position. But even when it comes to that, perspective is important. Dudley's math says that he thinks that the tax bill may increase the rate of GDP growth from 2.25 to 2.55. That's an accounting error. That's not enough for anybody to worry about. And whatever damage the tax bill did to our fiscal position, and it did, it's $1 trillion, but over 10 years, that's about $100 billion a year in an economy that is almost 20 trillion. Only 100 billion variance in the federal deficit. That's an accounting error too. So there isn't any rise of anxiety. In fact, the main report is anti-anxiety. The normal business cycle, where we overheat, and then the Fed makes us have a recession and we cool off and repeat the cycle over and over and over again. I've lost track of how many times, a dozen times since World War II, with the same general thread. Central to that business cycle is credit. It's in human nature that as times get better, bankers get stupid. If fewer people go into foreclosure, fewer loans go into default, bankers competing with each other for loan volume ease their terms, and they finally make their terms so easy that the new credit advanced is gold-plated to fail in a recession and make the recession worse, and also make the overheating worse along the way. Well, one of the benefits of the financial crisis 10 years ago has been the re-regulation of the financial industry. And by re-regulation, I mean turning it back to something that my grandfather, the banker in Oklahoma, would have recognized during the Great Depression as a return to good credit standards. Bankers are restive, mortgage bankers are restive, real estate brokers are unhappy. Applicants come in and are astounded that we won't make loans to them that they want us to make. But there is no relaxation whatever in credit standards. Not mortgage, not corporate, not nothing. Maybe in automobile loans, but even that's slowing now because everybody who wants a car has one. In this 10-year recovery from the last recession, nowhere in the economy do we find a relaxation in credit standards of the kind that would induce a recession or make one worse. So, life is a mixture of good news and bad news, but sometimes bad news is good news. And so reporting to you as an overly tight mortgage banker, it's good news. Have a good holiday.